two basic elements of a business are what it owns and what it owes. What it owns are assets, things like cash, accounts receivable, property, plant, and equipment. Things that it owes are called liabilities, and the difference between what it owns and what it owes is its equity. In the personal world, if I buy a house for $500,000 and I put a loan on it for $400,000, my equity in that home is $100,000. If I'm a business and on my balance sheet I have $500,000 worth of assets, $400,000 worth of liabilities, then my equity must be $100,000. The $500,000 minus the $400,000. The accounting equation says that assets, things that we own, are equal to our liabilities, things that we owe, plus our owner's equity. In other words, assets minus liabilities equals owner's equity. Another way to think about it is, if we own a bunch of stuff, outsiders have a claim against it, and what's left over are the claims that our insiders, our owners, have. So one of the first things you have to do in every accounting class is you have to look at a bunch of simple business transactions, and you have to determine what effect those transactions have on the accounting equation. So let's say that the owner invests cash to start the business. What's happening to assets? Assets are going up. Cash is an asset, so it's going up. What's happening to liabilities? Well, we don't owe anybody on the outside this money. It belongs to our owner. So remember, when the owner puts cash or assets in, owner's equity increases. Let's take a look at another transaction. We pay the monthly rent. Well, what's happening to assets? Assets are going down because we're paying cash out. What's happening to liabilities? Nothing. What's happening to owner's equity? It's going down. So in both these transactions, assets go up, owner's equity goes up, assets go down, owner's equity goes down, so our accounting equation stays in balance. So remember, our owner's equity increases when the owner puts in new assets, increases when the company makes or earns revenue. Owner's equity decreases when the owner takes assets out, and owner's equity decreases with expenses incurred. And that's what's happening here. We have a rent expense, and so our owner's equity is decreasing. Next, the company buys equipment on account. What does that mean? On account means account payable. So there's two uses of the word account. There's an account payable. That means we're going to pay money later. And then there's an account receivable. Means we're going to receive money later. So this is purchasing equipment on account. So what's happening to assets? Assets are increasing, right? Because equipment is an asset and assets are going up. What's happening to liabilities? Well, they're also going up. Any account that has the word payable in it is a liability. It means we owe somebody. And what's happened here is we've incurred an account payable when we bought that equipment. Let's take a look at another one. We bill customers for services performed. Well, if accounts payable is the bad one, accounts receivable is the good one. In other words, we're going to receive money in the future. We've done the work, we've performed the services, we've sold them the goods, whatever it is, we've sent out our invoice. Accounts receivable is an asset, so what's happened is our assets have gone up. We've earned some revenue, so our owner's equity has gone up. So again, the accounting equation stays in balance. Assets go up with the increase in accounts receivable, and owner's equity goes up with the increase in sales. All right, let's do one more. This one's a little bit trickier. The company buys additional equipment for cash. So why don't you pause this video and see if you can figure out what's supposed to happen to the accounting equation. Okay, so what's happening to equipment? It's going up. What's happening to cash? It's going down. So in this case, the accounting equation stays in balance because equipment goes up by one amount of money and cash goes down by the same amount of money. And so in summary, the accounting equation is assets, things that we own, equal liability, things that we owe, plus owner's equity, the difference between what we own and what we owe. And in every business transaction, that accounting equation is going to stay in balance. Hope this helps.